It is perfect. Then let me try to briefly explain what's happening in here and what type of tragedy we already experienced, especially in last 2 3 days, and what's happening in financial markets. Let's try to focus on these details. As you see, the risk indicators and volatility in the first quarter. By the way, title is first quarter, and first quarter already passed at the end of the match. But I will try to expand the analysis and explanation in the charts related to the last week. The first chart is trade policy risk about the tariffs between the United States and its trade partners. Please try to take a look at the left-hand side chart and the right-hand side chart and try to understand what these type of things showing up. By the way, these charts belongs to not the Trump's explanation, which is given huge tariffs, additional tariffs to these numbers. These numbers are after Trump come to power, he declares some additional regulation and tariffs to some countries in the Europe, in the Latin America, and in Asia Pacific. But approximately 5-6 days ago, the Trump implement additional tariffs policy, almost all countries in the world. But the logic is almost same. So if you can understand what's happening in the left-hand side and right-hand side chart, you will almost get the main point about these issues, how the trade policy, tariffs, and those type of things is working. So on the left-hand side, as you see, this is, please take a look at this one, tariffs imposed on the United States. So this x-axis showing the other countries putting tariff on the United States export. And the average is just here, as you see, around 2-3%, the all countries. The highest one is China. It is approximately 18% for the United States exports entering the China mainland, and all other countries almost collecting here. For instance, Singapore, Mexico, and all those type of countries, even zero tariff for the United States exports. And India, also like China, as you see here, putting approximately 12% tariff to the United States. And the y-axis, this one, is showing how much tariff the United States imposed for these countries. And as you see, the highest one, the reciprocal one, is China, approximately 12% tariff imposed to the China products entering the United States. But not reciprocally, the India putting 12% tariff, but the United States just putting 2% tariff to Indian products. And Trump really fear and really get tired from this trade deficit after his administration and try to close this trade gap between the other countries and the United States. And the basic answer for the United States authorities to solve this problem is putting at least the reciprocal tariff to all countries which is imposed on the United States product. And right now, we are almost seeing half of the countries, half of the tariff rate imposed to the United States product. I'm sure lots of people here see the table that is shown in news and TVs by the Trump at the late evening. And he said that we will put all these tariff rates to the countries which is a trade relationship between United States and those. And please take a look at this one. This is also really, really important. This x-axis showing the export as a percentage of nominal gross domestic product at the end of 2023, meaning that how much export is going to these countries. So the export is everything for these countries. Please take a look at here. Mexico, European Union, and South Korea. What does this mean? These countries giving current account surplus or trade surplus. What does this mean? These countries are really good in manufacturing, production, and capacity, in labor cost, in capital, and in also human cost and the technology. Please try to understand the basic solo model. Basic solo model saying that you should focus on some specialization with capital and labor cost, and also you should have some technological process to produce those products. And as you see, the export is everything for Mexico, European Union, and South Korea. In other words, if countries say, like Trump, we will put additional tariff on the European Union products entering our country, you will see in 1 or 2 years, European Union will collapse. Okay, this is not an exaggeration, because European Union is the center of the world product and almost technology, not like the United States, but we know that they are the center of the production. In machinery, in car, in robotics, they are really good. After the Second World War, you see almost all cars on the streets coming from Japan and the European Union, basically Germany, right? So if we stop to import those products from European Union, there will be no income for the European Union members or citizens, and they will collapse. For the South Korea, the most dramatic example, because South Korean people, you know, lots of well-managed and well-known brands like the LG, like the Mitsubishi, like lots of things produced with higher technology in South Korea and exported to the rest of the world. And they are really good in production and manufacturing. So if you stop to import the products of South Korea, they will have a dramatic decrease in their income, and you will see maybe a crisis or changing government authorities in the South Korea as well. Why this chart is important? This chart is important because of it is meaning how we can manage this process and how we can understand this type of style challenges in the rest of the world and how the export is important. For instance, the United States, the export is just 11% of GDP, meaning that 90% is coming from the other side, like manufacturing, like technology, like services, like the financial markets. So, I mean, the export is can be a negligible part for the United States, but it is an indispensable side of the GDP for the European Union, for instance. It is approximately 40%, as you see. So, could you understand what I'm trying to explain here? Why the trade is important for some countries, and why the Trump tariff is a really dramatic and disastrous result for those countries as well. And what type of volatility can this trade deficit, can the changes in tariff rate, trade balance, and any type of measures imposed by the United States and other trade members? This is the yield curve. Yield curve means the long-term government yields of the United States Treasury. Please take a look at here. On the x-axis, you will see the time frame, 3 months, 1 year, 2 year, 3 year. Please follow this mouse. As you see here, we have 3 months, 1 year, 2 year, 3-year, 5-year, 7-year, 10-year, and 20-year and 30-year. This is the maturity of the yield. Okay, these are really important. These are the maturity of the yield. And why the shape of the maturity of the yield is important? Why this is important for us? This is important for us that, please take a look at this one, this black one. This shape is taken in 2020, approximately 5 years ago. And as you see, as the maturity increase, the yield is increasing. This is normal because market is expecting an inflationary pressure in the long run, meaning that prices will go higher. So if I wait more from 3 years to 5 years, you should pay me more. This is the basic logic of the yield curve. But please take a look at this green one. It is 2 years ago in 2023. And this is an inversion in the yield curve, meaning that short-term yield higher than the long-term yield. Long-term yield is 4%, but short-term yield is 5.5. Why? Because investors expecting in the short term there will be risk and the inflation in short term, 3 months, 1 year. But in the long run, the central bank and the government will be achieved to fight with the inflation. And there will be no inflation in the long run. Or there will be an inflation, but lower than the short term. And today, when you look at the United States 10-year Treasury yield, it is still above the main streaming line. The threshold point for us for the United States Treasury yield is the 4%. When the Trump declared the new tariff policy, lots of people sold everything and buy the Treasury yield. You should also keep in mind that the interest rate on the Treasury yield is negatively related with the prices of the yield, Treasury yield, or how can I say, the Treasury bond. If you have a bond, if the prices is going up, the interest rate on the bond will decrease. So if everything buys the United States bond, what will happen? The basic answer for this is this. If Dr. Walchin, Domingo de Rosario, Samuel Matei, all these people put their money and buy the United States Treasury bond, what will happen to the prices? Prices gone up, right? Because everybody is buying, demand is increasing, and price is increasing. But interest rate, as I explained a few minutes ago, negatively related with the prices of the bond. If the prices is going up for the bond, yield is going down. And after the Trump declaration of the tariff policy, the yield go below to 4%. These 2 days was the really dramatic and disastrous days for the yield, Treasury yield as well. Approximately $1 trillion wipe out from the financial market, and they just suddenly enter the yield, government yield. Then, when the new explanation coming from the Asia Pacific side, China, Japan, India, or European Union, then people, volatility and the risk perception is decreased. Then they sold the United States Treasury bonds, and Treasury yield is started to increase still, today above the 4%. So from this picture, we can directly say that 3 days huge volatility in the financial market put a huge pressure on the yield curve. It decreased the United States Treasury yield below the 4%, but now market is trying to getting calmer. They are trying to getting calmer, and Treasury yield is increasing. Another chart for the volatility and try to understand what is happening in the United States and the rest of the world. This is another one of the best well-known chart for the interest rate and inflation. Please try to take a look at what this chart is trying to explain. This chart on the left-hand side, you will see the numbers. These numbers belongs to the nominal US Treasury yield and real US Treasury yield. And this nominal Treasury yield, this one, please look at it. Nominal Treasury yield was picked up in 1981 with 15%, almost 16%. But the real yields at the same date is almost here. Why? Because inflation is really high at both times. I'm sure lots of mathematicians here know how we can convert the nominal yields to the real yields. But for those who don't have familiarity with the concept, you can basically do this by converting something from nominal to the real. Real means there is no price effect on it. Okay, I'm adjusting and transforming the price effect from the nominal yield. If I subtract from nominal yields to the inflation, I will reach to the numbers of the real treasury yield. So if, let's say, nominal yield is 8% and inflation is 5%, I will have 8 minus 5, only 3% real yields, real purchasing power in the yield. And as you see here, the nominal yields at the end of March in the first quarter is approximately 4.23. And the real yields is just around 1%. Why? Because we have 3% inflation in the United States. And if I subtract these numbers from 3%, I will reach to the 1, around 1% real yield in the United States. The most important topics, how the market and central bank will react this volatility in the financial market. Because we all know that if there is a huge volatility, central bank can intervene to the market to decrease the volatility and risk perception. And we can also try to decrease any type of volatility perception and intervene to the financial market. What can be the next stage? You can see the federal fund numbers, and you can see lots of this chart is explaining the federal fund rate expectation for the United States. This is the Federal Open Market Committee policy rate, or you can call it as Fed fund rate. And here you see the years, the time frame. This is 1993 until here, 30 years we have. These 2 years, this and this, are the dramatic shocks and the recession and crisis period. The first one is dot-com crisis in the United States. And the second one is the global financial crisis all around the world. And the last one, a little bit small, it was the COVID-19 crisis throughout the world. And before the dot-com crisis, as you see, the United States Federal Open Market Committee policy rate here is 6.5. But with the crisis, it is dropping below the 1%. And for the global financial crisis, the Fed fund rate is almost 5%, and it decreased to the zero lower bound, like as it did in the COVID-19 crisis. Before the COVID-19 crisis, policy rate is around 2.5, and the federal fund rate decreased to the zero lower bound to increase the demand and consumption and trigger the GDP in the real economy. What is happening here? After the United States and the rest of the world decrease the interest rate to the zero lower bound, the demand and inflation is boom in the financial market. And to fight with the inflation, Federal Open Market Committees started to increase the interest rate, and they reached pre-COVID level 5.5, like as they did until the 2008 crisis. And now, gradually, with the inflation outlook, they are trying to decrease the Fed fund rate to fight with the inflation and to calm the interest rate and volatility in the financial market. But what type of responses can be done with the United States and Open Market Committee operation? Please take a look at here. This is the long run. And currently, you will see the explanation here. The black one, the line, is showing the Fed fund rate. The dark blue is FOMC estimates for the year end. What is it? It is 3.1. Market is expecting, however, 3.4, meaning that market is expecting Fed cut fund rates less than its projection. Market will end up around 3.4. And this purple one is FOMC long run projection. It will be around 3%. Why? Fed targeted around 3 or 2% long run Fed fund rate to fight with the inflation, which is the targeted level for the United States around 2%. So Fed is saying that if inflation drops to the level of the 2% Fed target, I will cut the interest rate as much as of that. So basically, what type of implication we can get from these clauses and this chart? This chart is saying that Fed is successive and have an efficient monetary policy implementation, and they are decreasing the inflation gradually. As inflation goes down, Fed is adjusting their policy, the Fed fund rate, it will be around 3%. But right now, lots of people expect from the FOMC, especially last 3 days, because of to decrease the financial market volatility. Why? If Fed make an emergency meeting and declare to the market that they can make an additional liquidity injection to the market, the volatility will decrease. But Fed declared it, and when it's open market committee meeting, the Powell said, I don't want to make a comment about the government policy because I'm responsible from the inflation and monetary policy side. So he declares and refuses any type of explanation related to the Trump implementation in tariff and trade policy. And this is the tariff. Please take a look at its historical time path from 1990s, global financial crisis. No, this is from the Great Depression till now, approximately 100 years. During the Great Depression, as you see, the United States imposed around 20% tariff to the rest of the world, and it decreased around 1% with the millennium years. But right now, as of 21st March, it is around 8%, but it will be around, as of tomorrow, here, it will be around 18%. Because this projection is before the Trump declaration, additional tariff to the rest of the world. And this will be take power and will be implemented 9 April, tomorrow. So if the new tariff and trade policy will be imposed by the United States, we will be here for the United States tariff level, it will be around 18% for the rest of the world, which is an unprecedented level since the Great Depression. And during this time, lots of people who don't want to deal with the volatility in the financial market, any type of perception of the risk, and any type of decrease in their income, they go to the cash balance and they increase their cash demand in the financial market. What does it mean? They are buying to the dollar or less risky asset. But when we mean by the dollar, what are the drivers of the dollar in the United States? How the price is moving? The price of dollar is moving with the United States trade or any type of policy or monetary policy or fiscal policy. Please take a look at the picture here. The dollar drivers, as you see on the left hand side, this is the dollar spot index. We called it the XY, and it is around here. The hardest time, the most appreciation in the United States dollar is 120. And by the way, in dollar spot index, we have 6 reserve currency: Euro, Great British Pound, Japanese Yen, Canadian dollar, Australian dollar, and Swedish krona. These are the 6 reserve currencies in the world, and their price movement according to the United States dollar is indexed. And these numbers is showing that is this index is decreasing, United States dollar depreciating, meaning decreasing against or losing the power against Euro, Japanese Yen, or Great British Pound, or Canadian dollar, or Australian dollar. Okay, so here, as you see, the United States dollar is really strong with the 110. And right now it is around 104. And still, what Trump is trying to do, he wants to depreciate the United States dollar and want to collect other reserve money in the United States by decreasing the value of the United States dollar, like the China do during last 20 years. Okay, if you depreciate your own currency, then you will collect other type of money by selling the products to the rest of the world. And on the right hand side, the United States trade balance, as you see, we have the current account balance for the United States throughout 2000 till now, meaning that approximately 25 years. During this time, we have huge volatility in the current account deficit and balance as well. Current account deficit meaning that you are importing more than you export, and you are giving the deficit in your current account. The United States current account deficit reached its highest during the global financial crisis, before the global financial crisis, approximately 6%. And with the global financial crisis, it is almost 2%. During 15 years, it is around 2-3%. And right now, their trade deficit started to increase again, and it is around 5-6%. And Trump wants to reverse this curve. He wants to be here. United States should give less current account deficit compared to the GDP, he said. And the basic way is for this, export more and make hard import from the rest of the world. In this way, you can give current account surplus, or you can decrease your current account deficit. And another contribution is coming from the dollar index, is from the interest rate differential between the United States and the developed market. And it is around here, as you see. The normal nominal number is around 1%. And if it is above the 1%, then meaning that Please look at here. Dollar is gaining strength. If this is dropping, then dollar spot index will lose the power with respect to the United States dollar. And especially the last 3 days, as I say, we have an index in the S&P 500. It is called Magnificent Seven Index. And those companies are Apple, Amazon, Google, Meta, Microsoft, Nvidia, and Tesla. And these companies, you know that, have a really divergence, positive differentiation from the S&P 500. They are gaining strength hugely when we compare it to the S&P. Please look at this one. This is the S&P chart, and this is the Magnificent Seven. For instance, if you put $1 million, it will be $1.5 million in S&P, and it will be 2.2 million in Magnificent Seven. Approximately 50% higher than the S&P average return. This is a huge return when we compare to the other things. And another point I want to make the clarification for this one. Please look at the title here. Time, diversification, and volatility. Especially in volatility times, what should you do? Normally we have, in normal times, we have 60-40 appreciation, meaning that stocks should be around 40 and bonds will be around 60. But especially if we have, please look at here, 60-40 portfolio. Normally the stocks are risky asset and their return is higher, around 12%, and bond is riskless asset and their return is lower. But when you make a combination of the 60-40 portfolio with the United States stocks and bonds market, you will get, for instance, if you have $100,000 for 20 years, what will be these numbers in the stocks, bonds, and 60-40 portfolio? In 20 years, $100,000 will be around $900,000. In bond market, it will be around $300. And in mixture, stock and bond mixture, it will be around 600. So the first question you should ask yourself is this: how risky I am? What type of risk I can take? If my portfolio decreased 50% in 1 week, may I make a panic? So if your answer is yes for this question, please don't buy this, ladies and gentlemen. Please don't buy this. First, ask yourself, how my risk perception? Am I a risk-loving person? Am I a risk-averse person or risk-neutral person? If I'm risk-neutral, take the 40-60 portfolio mixture. If you like risk, take the stocks. If you don't like risk, just take the bonds. Yes, you will get less, but without risk. This is important. Okay, you will get less, but without risk. So if you don't like to see negative numbers, 10%, 20% loss from your portfolio, please don't buy this green one. These are the stocks. These are volatile. These are up and down movements hugely. Okay, the bars in stocks is really long, not like in the bonds. So, especially in volatile times, the risk management is important, but the efficient risk management is you, not the numbers. Your brain, your patience, and your risk perception. If you are risk-loving, as I said, stocks. If you are risk-averse, bonds. If you are risk neutral, you will buy the 60-40 portfolio mixture. I think this point is clear because this is one of the best lesson we can take from this presentation. And as you see here in this chart, we have lots of annual return and intra-year decline. For instance, in dot-com crisis, 30% decrease in your portfolio. Ladies and gentlemen, please ask yourself again, Am I patient? And am I keep my calm if my portfolio decreased 30%? If yes, keep going. If not, don't touch and push the button of buy stocks. Okay, don't touch it. But the most important lesson you can take from here as well, any type of decrease in stock market, please look at these red numbers. These numbers or these loss or this decrease will not go until infinity. Okay, there will be always a market recovery because lots of investors know the real value of the something, and if it is decreased to the cheap side, everybody will buy. Okay, if something is 100 2 days ago and today with the same quality, with the same other thing, if the price is 70 today, you can think of buying because yesterday it was 100. If there is no risk, no other things about that, and if the price is going $30 in one day or 30% in one day, if everything is going same with that company, same with that market, lots of people will understand that it is cheap now. Okay, how much it is cheap, how much it is expensive. In the previous classes, I explained this issue multiple times. I'm sure about it. And here, these are the single stock volatility and equity market return. Here the numbers, these are the years from 1995 until now, meaning that we have 30 years here. Okay, approximately 30 year I have, and I have some decrease in the market. And how can I complete the year? At the end of the year and at the same point in the year. For instance, if there is please look at this one, number of S&P 500 stocks with a crackdown 5% or more. Please look at the green one. This is showing that year drop side, and this one showing the number at the end of the year. So, I mean, if you are patient, if you look at these bars critically, if you are patient enough, if you can manage your risk, if you can understand the logic in the market, you will get your money at the end of the year, or you will even get more money if you are more patient. But if you are waiting the correct bus in the correct station, this is important. Okay, if you are in the correct station and if you are waiting the correct bus. For instance, if you want to go to one side but that bus station is never passed from that, don't wait there. You will lose more money. Even you don't lose more money, you will lose huge time by waiting. Okay, and here this is showing another chart, another great chart for the financial market volatilities and their explanation for this. These are explaining for us that the correlation and volatility for the macro indicators. What type of macro indicators I have here? I have here lots of the big market challenges. I mean, market indicators for any type of asset. United States large capital, emerging market, bond, corporate, high yield, municipalities, currencies, commodities, hedge fund, private equity, or gold. And here, as you see, what is the volatility for this? Please look at this one, gold. Annual volatility are these. Okay, these are important. Annual volatility for the gold is around 13%. But for instance, for the municipality bond or currencies, it is 5%. These are less volatile than the gold or commodities. Please look at the commodities. As you see, 16% volatility in the market. So if you are taking position in commodity, you should be ready to up and down at least 18 or 20% volatility up and down. But for instance, if you are in currency, it is decreasing at most 5, or it is rising at most 5. In any case, this correlation showing that if, please look at this one. For instance, my correlation for gold, look at the gold and United States large cap, really low correlation, 0.25. Let's look at high correlation, for instance, with the gold. What are the high correlation? Bonds, as you see. If gold price is moving 1%, or let's say it is increasing $100, bond will also increase $66. This correlation analysis saying the same. Okay. Or let's look at from here another high number for the bonds. It is the municipality bonds as well. It is saying that if gold price is increasing 100, then the bond municipality prices will also increase $52. But if gold increase $100, what will happen here? The currencies depreciate approximately $60. Negative correlation with the gold. Because if somebody sells the gold prices go down, currency will go up. Negative correlation.